Alex, thanks for joining us.
Thanks for having me.
It's such a pleasure to have you here. You've had an incredibly, impressively interesting life long before crypto. Just get us a sense of where you began your life.
Yeah, so I was born in the Ukraine when it was still back in 1965, when it was still back part of the USSR, my father was a Zionist and he wanted to move to Israel, and so he became a refusenik, one of those guys that kind of instantly lost his job and had to sit and wait to get a visa to move to Israel. And I think Arm & Hammer brokered a deal for the United States to give 300,000 metric tons of wheat in exchange for 300,000 Jews leaving Russia. And most of these Jews came to Brooklyn or the US, and my father was like, no, we're going to Israel. So we land in Israel, and like 3 months later, the 1972 war starts. And my mother wasn't really happy with him because she was like, you took us out of communism, but you brought us into like the worst time possible. So I grew up in socialism in Israel, right? Out of capitalism into socialism. Sorry, out of communism into socialism, and went to the military there. And after that came to the States and did 8 startups, one after the next as a founder. So definitely found my calling. And now Israel is the kind of the land of startups, right? The startup nation. But I guess I was a little bit ahead of my time there.
Yeah, so you're one of the few people we were talking offline to, be an active participant in startups who's seen all 3 systems: communism, socialism, and capitalism.
Yeah, it's definitely interesting because I think most people kind of would say, of course, capitalism is so much better. But today's capitalism doesn't work for 99% of the population. It really works great for the 1%. I'm part of the 1%. But I came with nothing. I mean, when we left Russia or the USSR, they took away all of our possessions, all of our belongings, because we were like these people betraying the motherland, So I know what it is to grow up with nothing, and really everything that we created was through hard work. But capitalism definitely does not have a safety net, and if you don't make it through, it doesn't. You could end up on the street. So I think each system has its own advantage and disadvantage, and we still need to tinker and fix things to make it work for everybody. Yeah. At least that's what I believe in.
Yeah, very well said. So, we were talking a little bit earlier about your background as an entrepreneur. You've done a lot of really interesting things. You have a very strong background as an entrepreneur and developer in the telecom sector. You were involved in the early implementations of VoIP, that's voice over IP for people who may not know. You traded commodities. I mean, you just have this really interesting background. Tell us first about the telecom space and how you became involved.
Yeah, so I have a very creative mind. I managed to figure out early what I'm good at. I think I'm trying to do that with my kids, help them kind of figure out what they're really good at instead of trying to be good at a lot of things. Try to find the one thing you could be best in the world at. And I figured it out. I was like, hey, I can give me a technical problem that involves any kind of networking or infrastructure or protocols or communication, and I can come up with a better way, really, I was lucky that the internet was just getting started. So being in the right place at the right time is just as important as having any kind of skills, right? If you're the best golfer, but Tiger Woods is world champion, it doesn't help you. You're still not going to be champion, like at least 5 or 10 years ago. So here, the timing was phenomenal because actually the whole thing started with the VoIP thing started with the U.S. State Department complaining that the United States was paying tremendous amount of money in settlements to the foreign carriers, like to KDD and British Telecom and so on, and they tasked AT&T to come up with a solution of how do we balance out billions of dollars that the U.S. was paying out in settlements. And AT&T had problem coming up with a solution. They used Bell Labs and they couldn't engineer a solution. And I came up with this way of basically bypassing the traditional infrastructure, right? That was the task, is how do you get around the bilateral infrastructure, TDM, time division multiplex infrastructure that existed. So really, the State Department and AT&T were the ones who seeded voice over IP, because they basically paid for someone to come up with a way to get around the system. And now all of us are getting around the system. We're using this video communication back in the early 90s would cost $3 or $4 a minute because it was so expensive, and you had to use AT&T, and you needed special ISDN or frame relay lines that were very expensive. And today, every one of us, my kids have 6 sessions going on with 6 of their friends at the same time. 6 HD sessions. It's like I would dream about that in the 90s, because obviously didn't have that much bandwidth. But basically, the minute you open that Pandora box, everybody wanted a solution. Everybody wanted to bypass the traditional settlement system and use voice over IP. So the adoption curve was very, very quick. Hundreds of millions of people used it very quickly. And that's why I always joke that for me, crypto, or money over IP, as I call it, is just seeing the same movie again, right? Because it's kind of like just taking it from the banks instead of taking it from the phone companies.
Right. Before we move on to that, I understand that you're one of the people who's most responsible for being able to receive texts on the New York City subway system, which is something that back in the day when I left my apartment, it would do all the time. Yeah.
So it actually happened after September 11th. So my best friend died at the towers, and basically when the system crashed, when the towers crashed, the subway system got shut down completely. People got stuck in the subway for hours, and they couldn't communicate. No one could talk to anybody else, right? Because if you remember the old ways of the subway, there was like a payphone on each side of the station. And if somebody else wanted to talk on it, you basically didn't have a choice. You had to get out and maybe find a phone on the street. And I kept asking myself, how is it possible that in the World Financial Center and the most advanced city in the world, there is no wireless communications in the subways? I mean, I used GSM in the metro in Paris in the late 80s, right? And here we were in 2001. And there was still no connectivity. So I basically took that as a project. I said, I'm going to make it happen. Whatever it takes. And it did take several years just to convince the MTA to basically issue us a franchise to allow us to build it. And it was one of those build it and they will come, because the carriers definitely did not want it was like over $300 million worth of infrastructure, right? So they didn't want to spend the money just so people could use them even more, right? It's like a gym membership. The gym guy doesn't want you to shop in the gym. He just wants you to pay for the monthly service. But we built it. We got 8 million people to use it for free. And you get 5G, you get Wi-Fi, and obviously you can also text. So this was my second win against the phone companies, So they were... But those 2 wins were practice for crypto, because winning against the banks is definitely much, much harder than winning against AT&T. So,
yeah, I grew up in Northwest New Jersey in Bell Labs country, and it's interesting for people who are younger who don't remember those days. You could think of AT&T as almost being like the Google or Facebook of its day. It was this massive monolithic company that controlled effectively the standards that were used to communicate across the country and across the world.
Yes, yeah, they were definitely, and they were great. I mean, look, Bell Labs, the laser came out of Bell Labs. There's several Nobel Prize winners who came out of Bell Labs, right? So tremendous amount of innovation, but a lot of the transistor came out of Bell Labs as well. So, but a lot of it was inside this ecosystem of what AT&T thought the world should look like. And when the internet was trying to break out, it's very similar to what's happening now in crypto, because basically you had the government version of the internet, you had the corporate version of internet, which was like IBM and Prodigy and AT&T and other people, and then you had the open source internet, right? Which is what we're using today. And it wasn't clear in 92 or 93, even in 95, it was not clear that the open public internet is going to be the winner. And we're going through the same thing right now. We're going through this, central bank digital currencies, right? China, United States, other countries, which is like the government version. We have the corporate version, which is Libra, and other companies like JP Morgan. And then we have this open source public blockchain, right? And it's not clear who's going to win. I can tell you right now, it is definitely not clear that Bitcoin or Ethereum are going to be the ones to get to the finish line.
That's an interesting and almost heterodox or a very controversial view.
Well, so again, I've been in tech now for, I don't know, 35 years, and I can give you many examples where not the best technology wins. All right, like look at Apple, Microsoft, right? Version 1.0. I'm not talking about recently, right? And so on. So assuming that Bitcoin is the right solution, and I've said this publicly several times, I don't think that the winning blockchain has been invented yet, because Bitcoin is exceptional for store of value, but it is not a form of payment. And I think what Libra is working on is definitely a much more advanced and scalable form of payment. And it really is going to compete with ETH 2.0. And we have to see what's going to happen there. At the same time, if you look at what China did, right, where they went to one of their big cities and just dropped $15 million worth of the digital yuan and just seeded the market, right? They did an airdrop, basically, of yuan, and people are whining about ICOs. They did an ICO in China. It just happens to be the national currency, ICO.
I'm curious, what do you think about the Bitcoin maximalist position who view the notion that there are going to be other developments in the space almost as a heresy at this point?
Look, I definitely am a Bitcoin maximalist. There's no contradiction between Bitcoin as a store of value being worth trillions of dollars and a form of payment, which is the platform for 7 billion people on the planet, the Internet of Money being a completely different system. So the two don't have to be the same thing. They can be the same thing, but they don't have to be the same thing. And today, we're still struggling with, look at China. China has 1.3 billion people using your phone, but they're not using the blockchain. They're using just, digital payments, right? So with digital currencies, but it's not a blockchain-based system. So you don't need the blockchain necessarily to do this. And the Chinese government is not telling you we're going to have a limited supply of yuan. They're going to keep printing yuan. Right? The digital dollar or the digital euro are not going to have limited supply. So if you don't have limited supply, then why do you have a blockchain, right? So the uniqueness of Bitcoin is that it is non-correlated and that it has limited supply that no one can change, right? And today, by far, the world's largest supercomputer is the Bitcoin network. So no one has the computing power to compete with that, right? So by definition, it already escaped that a level of control that everybody's worried about. It's just impossible to put that genie back in the box.
Yeah. It's almost as though there's an inherent level of conflict between the medium of exchange function and the store of value function, that what makes for a great store of value almost necessarily has an impediment as a medium of exchange.
That's right. So store of value needs to reach a plateau where the volatility diminishes and it gets this mass adoption to become a form of payment. But Bitcoin has not reached the volatility, has not subsided, and it has not reached mass adoption. So and that's why it's doing so well. So we as Bitcoin holders, I think you hold some Bitcoin as well, and Raul has it and so on, right? So we're all cheering for it to keep doing what it's doing. We don't want it to be a form of payment, because as it becomes more and more a form of payment, that means that the upside will be capped. So because the mass adoption of it as being a form of payment actually decreases its ability to be used as a phenomenal store of value. So the two do contradict. And look, the US dollar went through, most people don't know, the US dollar went bankrupt twice. And only the third version of the US dollar became the world reserve currency. So, but before the US dollar, the British pound and every other currency went through exactly the same thing. Every fiat currency went through the same thing, where in the beginning it was a store of value because it was made out of gold or silver, and then it became a form of payment.
Yeah. And that brings us to where we are today, which is the DeFi revolution that's happening. DeFi is one of the buzzwords that gets used a lot, and I think there are different people who have different definitions of it. What's your understanding of what DeFi is, and what's its significance in this space?
Sure. And again, there's hundreds of videos of this, of me talking about this subject going back to 2017. So if anyone wants to look it up, they're welcome. But basically in 2016, 17, and that's why I got into the space. I wanted to do something in fintech for a very long time, but there was nothing out there that I saw that could put a scratch on the banks. I mean, for me, when I look at PayPal or Venmo or the Cash App, none of those companies put a scratch on JP Morgan or Citibank or anybody else, right? And finally, when I saw crypto, and I was a skeptic in the beginning. It's not like I was like one of the early adopters, but when I saw the ability to, just like with the phone company, to bypass the network from the TDM network to the TCP/IP network here, from the rails, from the SWIFT and the IBAN rails to basically a blockchain, I realized that it's all going to be about two things. One was store of value, which we already had. There was no point creating another Bitcoin. And the second one was all about yield. And I think, if I'm not mistaken, no one has pointed to any earlier example than Celsius, but when we launched Celsius, it was 100% about yield. It was all about showing people how Bitcoin can yield, how Ethereum can yield, how Litecoin can yield. Now we have 41 coins and tokens in our wallet, and Celsius was the first one to generate yield. All you had to do is take your coin, deposit it in this wallet, and magically it created more Bitcoin or Ethereum and so on. And a few months later, we launched not just earning in kind, but also earning with a token. So a year and a half before Compound, a year before Uniswap or Aave, Celsius launched the first option where you could deposit Ethereum and then earn sell token as the yield enhancement, right? And so on. So I would like to say that we just called it MOIP, or money over IP. And a year later, everybody else came up and said, no, we call it DeFi. It's much more cool. But it's, again, I'm not trying to get credit for who invented it. The point is that yield is the second killer app for crypto. That is the most important thing. And now there are hundreds of companies that are all chasing this yield, right? So, and we did exceptionally well. Our sell token is up 4,660% this year. So it's one of the best performing assets in the world. The company is worth over $1 billion. We have over $3 billion in AUM, in assets that the community has given us, over 220,000 users worldwide. So definitely we benefited from this, but also we created a whole community of users who come to crypto for that reason, right? So me and you probably came to crypto because we believed in Bitcoin. But now there's a whole slew of new people that are coming because they're just searching for yield. And it's not because we are so good or Uniswap is so good. It's because the banks are so bad. They're paying you 0.1% for your money, and we're paying you 10% for your money. So that's 100 times more. So something must be broken here. Either we are lying and cheating, or the banks are stealing from you day and night. So go figure out what's real and what's not real.
Well, let's unpack that a little bit and explain how that works, the supply and demand dynamics, and how you get that yield offered on those coins.
So first, and I've done this in one of my AMA, I went actually to the JP Morgan balance sheet, the quarterly statement that they issued to the SEC, and I dug through the numbers and showed people that JP Morgan itself yields about 17% on its assets. So it knows how to generate tremendous return for itself. It just that most of the banks choose to give all of it to their shareholders and not to their depositors. So banks are exceptional at extracting fees and making money on the money, but then giving all of that to the shareholders via stock buybacks and dividends, right? And what Celsius created is the opposite of that. We are structured almost like a hedge fund, even though we're not, but we are like a 80-20 LP-GP relationship, meaning our users are LPs. They lend us their coins. We deploy the coins, we earn yield, and we give 80% of it back to the depositors. So we don't give anything to the shareholders, right? And I'm the largest. I have over 100 million of my own money in the Celsius wallet, sitting right next to all of my other users. So I have a huge incentive to pay myself as much as possible, but everybody else who comes in gets exactly the same rate. But to answer your question, how is it possible that Celsius can pay 10% on stable coins, which are just a digital version of the US dollar? Same thing JP Morgan is using to make their 17%. We're making 15 to 17% as well. And the main reason is that the velocity of money in the digital world, in the crypto world, is 10 times greater. And you can look it up. Look at the M2 and look at the velocity of the dollar going down, and look at the issuance of stable coins in the crypto community. It's now $19 billion. It used to be $4 billion last year. It's now 90 billion. It's going like crazy. 10 times the velocity of money, meaning the same dollar is moving 10 times in and out. And because of that, people are willing to pay much more for it. So if I'm a trader and I'm hedging or I'm arbitraging Bitcoin price between Coinbase and Binance, right? I need to borrow Bitcoin. So I go to Celsius and I borrow Bitcoin, and then I need to borrow a digital currency, because if I'm this or that major trading firm on Wall Street, my compliance department is not going to let me buy USDT. So I have to borrow USDT and I have to borrow Bitcoin. And I'm willing to pay. I'm making 10% a month, not 10% a year, because at any moment the gap in price between Coinbase and Binance can be 2 or 3%. So all I have to do is sell on one and buy on the other. But to do that, I need both sides of the transaction, Bitcoin and USDT, or Ethereum and USDT. And all Celsius does is it pulls the assets from the people who are long-term players who don't care what the price is tomorrow, and lends them out to the institutions who are willing to pay these yields to borrow the asset to offset the risk, right? Because they don't want the exposure that Bitcoin moves or something else flash crashes. Because with Celsius, they just return the asset, right? They borrow Bitcoin at 12,000. It's now 10,000. They just return the same amount of Bitcoin, and it's not their loss. It's the community's loss. But our community is long only, so they don't care. They just want that 10 to 15% yield. So it's a long way of explaining. On Wall Street, it's called SEC lending. So if you know what SEC lending is, we do SEC lending, just lending crypto assets.
Yeah, so it's securities lending. Effectively, you're saying is the driver for this is you have these riskless arbitrage opportunities because of inter-exchange deltas. Wall Street firms need to borrow in the assets so that they don't take on the risk position. And then effectively, it's just a securities lending platform that you're building, and then the yields get returned to investors via the token and via the interest rate paid out.
And we lend out billions of dollars, 41 different tokens and coins. We only list in our wallet things that yield. So people keep asking me, why don't you have Cardano? Why don't you have whatever? I'm like, I can't create yield on it, right? And it basically has three buckets of assets. It has 11 stable coins. So if you don't believe in Bitcoin and you don't believe in gold, great. Just take your dollars, convert them into stable coins, but through Circle or Coinbase, buy USDC or USDT or TUSD or GUSD from Gemini. You deposit in Celsius, you earn 10%. You have zero exposure to crypto, right? And the borrowers give us collateral. So it's not like we're giving naked loans. These are all collateralized loans. But if you want, you can also basically buy gold, tokenized gold. We have Tether Gold, Pax Gold, and CoinShares, which is a DGLD. And basically those yield 4.5%. So imagine have GLD, the ETF, but instead of paying 0.65% expense ratio, you have 4.5% a year of more GLD being given to you by your administrator. So these are beautiful ways to both diversify and earn yield. And like we said, against the banks, that's 100 times more than JP Morgan will pay you, even if you give them $100 million.
Yeah. So let's talk about how the collateralization takes place. One of the things that we found out during the global financial crisis in 2007, 2008 was rehypothecation risk, and how there was a risk with assets being able to track them down and being under collateralized. How do you guys collateralize these assets so that there aren't troubles on that side?
Yeah, it's a great question. And sec lending is the safest business on Wall Street. I think in 100 years, not a single Wall Street firm went out of business because their sec lending blew up. Their derivatives blew up, their, all their mortgage business blew up, but it was never the sec lending desk. And the reason for that is that normally it's pretty easy to manage that risk or counterparty risk because there are many, many ways to hedge against it. Now, in the crypto world, we have two types of lending. We have retail margin lending. So if you have one Bitcoin and it's worth $18,000, we will give you 50 cents on the dollar. So I hold the Bitcoin and I give you $9,000. So obviously we have 2x or 3x. Our average right now is actually 30%. So we have 3x, more than 3x of assets against what we're lending out, right? So there, the risk is very low and we have the collateral. And if we need to liquidate, we just liquidate the asset. There's plenty of liquidity to liquidate hundreds of millions of dollars a day worth of Bitcoin or Ethereum without any problem. So that's one side of the house. The second part is the institutional side. And here we have mega multi-billion dollar balance sheet companies that are the biggest traders on Wall Street, the guys that do 80% of the volume on the New York Stock Exchange or the NASDAQ every day. They all have a crypto desk. And there we are taking some counterparty risk, even though they give us collateral. Usually they'll give us less than 100% because they have such a large balance sheet, right? And so most of our business is with these very large onshore institutions, not the offshore guys. But we also have smaller hedge funds. And the smaller hedge fund, like a Hong Kong-based hedge fund or Singapore-based hedge fund, they will post more than 100% collateral, right? So they'll give us the asset they have. Most of them, almost 100% of them are dollar denominated. So they'll give us 150% in dollars, which we need to lend out anyway. And we will give them the Bitcoin or Ethereum, which is what we have. Our customers are crypto denominated and our borrowers are dollar denominated. And that's why our business is doing so well, right? Because in the traditional world, there will be many, many people in this business. But in the crypto world, it's actually very difficult to find a counterparty that will lend you 50 million worth of Bitcoin in one transaction. Try to do it, right? Try to find someone who will give you 50 million worth of Bitcoin, right? So, or 100 million worth of Bitcoin. So we do these transactions every day. Sometimes these borrowers will take it for a week. Sometimes they'll take it for 3 months, right? And our entire business is basically managing the book. And DeFi is very similar to that. The problem with DeFi is that the pure DeFi, right, is that most of the compound borrowers or the Aave borrowers and so on are all retail borrowers who are just borrowing it for leverage. They're borrowing it to do farming on the platform. So I don't call that real yield. That is like a yield that is based on hoping that the next person is going to show up and I'll be able to sell my comp or my Aave to them at a higher price, right? So our business is much more diversified. We have exchanges, hedge funds as customers, right? We have over 300 of them. So yes, we have maybe 10% of our assets in DeFi. And I love DeFi. I think DeFi is a great place to experiment and create new protocols and new ways of creating yield. But today, most of the yield in those platforms is not the traditional yield that you would think when you are working on Wall Street or when you're buying a bond or you're buying a treasury, right? So I just want to warn the people that are watching the show not to think that everything that's called yield is the same thing, right? So on Uniswap, for example, there's, I think, 2,000 pairs of coins. And even though some of them yield 1,000% a year, you're taking huge risk on what actually the coin that you're getting. When you're placing your coin there to provide liquidity, you're effectively taking risk, impermanent risk on a token that you may not want to own, that may be worthless, right? So a lot of people don't understand that, and they're just chasing yield blindly, and then they find out that they lost money and they don't understand why. So our job is really to be effectively the shepherd here, to keep people away from taking these very risky bets and find the places where you can earn good yield but not take a lot of risk. Really, that's what we do better than anybody else, I think, in crypto.
And in the case of the institutional sec lending clients that you have where they're collateralized at less than 100%, if the market for the coins hits an air pocket and there's significant volatility, what happens when they're under collateralized? You make margin calls against them and they basically top up.
Yeah, so March 12 is a perfect example. We we had over 600 margin calls on March 12th, right? The Bitcoin dropped by 40% in 12 hours. All of our institutions provided more collateral on all of those margin calls. We did not have a single liquidation with a single counterparty, right? And if you look at most of our competitors, they liquidated most of their customers because they were retail customers. So if you were using Maker, if you were using Comp or whatever, it's a smart contract. They don't ask you questions. If you didn't have time to provide more liquidity or more collateral, you got liquidated and you got charged 15% for that liquidity fee, right? So you just lost 15% of your value. With Celsius, you got an advance warning. We told you a day before the crash, we told you markets are very volatile. Please add more collateral. We gave you another warning with a push message that said, hey, Bitcoin is crashing. Please add more collateral. And because of all of that, we didn't have to liquidate any of our customers, right? So we walked out of March 12th smelling like a rose, while other people had to liquidate most of their users. So and look, it's not good. It's a horrible thing for our community, where we have people coming from fiat land to crypto land. They get squashed or liquidated, and they go back. We want them to stay. We want them to earn. We want them to feel like we are the replacement for the banks. If all we do is make them burn their fingers, this industry is not going to grow. Your Bitcoin is not going to be 20 or 30,000 if you keep burning people coming in. So I love DeFi. I love the excitement, but we need a better form of generating yield that does not rely exclusively on retail guys doing farming.
Yeah. I'm curious, how do you think of your paradigm? It's not DeFi. Do you think of it as centralized finance? I mean, how would you structure that conceptually?
Yeah, it's a great question. So we have no problem people calling us CeFi. Some people call us DeFi or centralized finance or decentralized finance. But the truth is we have a leg in CeFi and a leg in DeFi. And I'll give you a perfect example. So let's say you are a sophisticated guy and you have plenty of wrapped Bitcoin, which is a form of Bitcoin, and USDC. And you went to Uniswap and you put that as an LP, a liquidity provider. You put that on Uniswap and you're now making 18% yield. Beautiful, right? Wrapped Bitcoin is a great asset. USDC is a great asset, right? You feel pretty safe. Both wrapped BTC and USDC are centralized assets. So 100% of your position is centralized. So do you call that DeFi or do you call that CeFi? You understand? So there is no pure DeFi or pure CeFi. There is yield and there is acting in the best interest of the community. And Uniswap is a beautiful project that acts in the best interest of the community. It allows people to exchange from one position to another, and the value created through that exchange is given to the liquidity provider. The people are willing to provide the coins to enable that to happen. So 100% of the value stays inside the community, right? So that is a purely DeFi project running CeFi assets. So one leg in CeFi, one leg in DeFi.
Yeah. It's interesting, there's such enthusiasm right now for everything decentralized, for everything, not just decentralized, but really programmatic. It takes a lot of skill to manage positions so that when you have a significant sell-off, you don't lose money and you don't have to liquidate. That's a very interesting paradigm to think about how those two are playing out in the space. Definitely,
and in crypto, because of the volatility, it is 10 times worse than it is on Wall Street, right? So on Wall Street, right, stocks move 2 or 3% and people get margin calls. Here's Bitcoin can move 40% in one day. So, which people didn't think was possible. But in one day on March 12th, it moved 40% and then it moved back 40% in just a few days, right? So you definitely need, and also the liquidity on Wall Street is concentrated with 1 or 2 major exchanges, where in the crypto world, it's really dispersed around 15 or 20 exchanges, including derivative markets like futures and options and so on. So it's a much more complex market. And because of that, it's also prone to manipulation. And that's why I think the SEC and other regulators are so careful about enabling ETF and other things, because they don't want the retail investor to get burned just because the tail is wagging the dog here.
Yeah. Very interesting. So let's talk a little bit about the token. It's a utility token, a revenue share token. Your token is not governance related. Is that correct?
Look, anyone who calls their token governance is just hiding behind not calling it a utility or a security token. There is no such thing as a governance token, right? So the way the regulators look at it is security or not security. They don't care what you call it. You can call it apple pie, right? What they care about, is it a security or is it not a security? And the bar actually is very different in Singapore or Hong Kong or London or New York City, right? Yeah. For the same thing, right? And because each market has to decide for themselves, like the Brits have to decide for themselves, do we want this business in our country? Do we want it to be done from our a legal system, and what does it mean? How do we enforce it, right? And there's plenty of experimentation going on. So I can't tell you that one has it right and another one doesn't have it right, but I can tell you for sure that this model where you don't do KYC, you don't do AML, you call it a governance token, and you allow anybody to do whatever they want, is probably not going to last. I mean, sooner or later, regulators are going to crack down on that, just like they're cracking down on all these offshore exchanges that thought that they were not governed by U.S. laws or anybody else. So Celsius from day one, I mean, one of the first things we did when we formed Celsius was register with the SEC, register with FinCEN, deliver our white paper, explain to everybody what we're doing. We filed with the FCA, right, and so on. So we believe that doing KYC, doing AML on every one of our users, which obviously makes it much more difficult to use Celsius than to use Uniswap, is a good thing for the community, because our job is to protect the community from bad apples. And if we use regulation to keep the good apples in and the bad apples out, it's good for the community. So instead of looking at it as a how do we avoid the law, or how do we skirt the law, or how do we go offshore to not follow the law, we really need to take the good parts of the law and use them to make the community more powerful. After all, we started talking about it at the beginning of the interview, right? All we're doing is we're taking the power away from the banks and giving it back to the people. Because if you as an individual, you go to Citibank and you say, look, I look at your balance sheet and I know you're making 17% of my money, my salary that I just deposited with you. You turned around, you lend it to my neighbor, you charge them 24% on their credit card. I want 80% of that, right? You have zero chance of being successful as an individual going against the bank. But if I collected 1 million individuals and now I have $10 billion of assets, I have 100% success rate convincing the borrowers to pay us 15 or 17%. So this is a game of most people don't understand that they have the power. Just like AT&T thought they had the power, and all of us switched to VoIP and they realized they have no power. It's the same thing with the bank. Banks don't have any power. If all of us stopped depositing with them, they would disappear. They would have to sell all these beautiful buildings here in Manhattan and go and find a new business, because today they're not delivering any value to the depositors. They're delivering all their value to the shareholders.
Yeah. And like what happened with long distance carriers, the price model collapsed when it became commoditized.
Exactly. So it's the same thing here. The idea that you can charge your customers to deposit money, to withdraw money with the ATM fees, no activity fees, a checking account fees, you can create fake accounts and charge them $20 a month, that is just lunacy. So all we did is created an alternative that runs on a different set of rails, that generates 100 times the yield that the banks pay you. And each individual has to decide, do I want to continue being in this abusive marriage with my bank, or do I want to get a divorce and go and use it somewhere else? That's really the decision that we all have to make. And the faster we make that decision, the faster we will force the banks to do the right thing and revisit their relationship with their customers.
Yeah. We were talking a little bit about the regulatory infrastructure a little bit earlier. Obviously, it's still incredibly early in this space. So how do you have that conversation with your regulators? First of all, who are the regulators in this space who are regulating you? And how do you think about that conversation with them?
Look, first, the SEC, I think, issued 67 lawsuits to date on crypto companies. So when you inside the crypto bubble, you would think that the SEC is this horrible institution that is there to get every crypto company and so on, but that is so far from the truth. Again, if you issue an initial coin offering and you do not register with the SEC and they think it's a security, they're going to file a lawsuit against you.
Yeah.
And your lawyer should have told you from day one that whatever you're planning on making is a security. So we didn't know if our project is a security or not a security. So we filed. It costs less than $5,000 and it takes about 1 day of work to file with the SEC. We're not talking about hiring 5 auditors and working for a year. It's just 3 pages of information that you have to do. So I think that the crypto community has created this image that regulators are coming after us and it's a fight between us and them. And Celsius is a perfect example. We operate in over 100 countries. We don't have a single issue with a single regulator in a single country because we follow all the rules. We follow the KYC rules. We follow the AML rules. We follow the issues that have to do with deposits and withdrawals, using custodians, right? GDPR, all these things that you have to do if you're acting in the best interest of your customers. So the UK regulators look at everything we're doing and they're saying, good, you're following all the rules. Good, keep going, carry on. So my point is that every project in crypto can just copy. We published everything we do. Everybody can copy everything we're doing and not have any issues with regulators.
Mm. And how are you regulated? Are you regulated as a broker-dealer, as a bank?
So because we do lending and borrowing and basically we rehypothecate, there are many, many, many laws that apply. There are laws that apply to privacy of information. There are laws that apply to what type of custodians you must use. Like in New York, you got to use somebody who has a BIT license or equivalent, right? So we currently, I think we're the only company in the world that offers the yield service in New York State. Why? Because we went through the hustle of figuring out who has a BIT license and integrating with them so we would be operating under their umbrella. No one else bothered to do it, right? So again, none of that is difficult. It's just you have to know what the rules are, and then you have to be compliant with all the rules, including knowing your customers, anti-money laundering, and all the things we just talked about. So there are a lot of rules. I'll give you an example. In New York, if you're charging less than 15% interest, you don't need a lending license. But in California, you need a lending license. So if you did not apply with the state to get a lending license, you're not allowed to do that margin lending that I was talking about before. So it's not like there's one rule that covers any country. Even inside each country, there are many variants. Like in Canada, for example, each province has their own rules. In the United States, each state has its own rules. In Texas, for example, you're not allowed to accept stable coins as a deposit or as collateral. So we block people from Texas. But all the DeFi platforms accept people from Texas. So you tell me, what is better? Do you follow the rules or do you break the rules?
Well, I'm a rule follower, so I find it, yeah, I mean, and also for two reasons. It just seems as though if this is something that's going to scale, and I have friends who are across the spectrum on this, some who sort of fall into the crypto anarchist category and some who are very sort of staunch institutionalists. I'm probably more toward the institutionalist side of that continuum. But to me, it seems as though if we're going to get scale, if we're going to get institutional participation in this space, the only way to do that is to be compliant with the necessary federal and state regulations.
Definitely, and I think that we are slowly getting there. I think more and more of the users, more and more of the people that we work with every day are realizing that, because traditionally we thought that we could just operate in the ether and nothing will happen. But if you want your Bitcoin to be more valuable, and people are celebrating Paul Tudor Jones, he bought all this Bitcoin. He didn't buy Bitcoin. He bought derivatives on the CME, right? So why didn't he buy Bitcoin? Because of all the things we just talked about in the last half hour. So if you want people to actually buy the underlying asset, you need to make sure that everything is compliant. And again, the SEC not approving an ETF tells you everything there is to know, right? I mean, there are very good reasons why they're not approving it. It's not because they hate Bitcoin or because Treasury told them not to approve it. So I think we as an industry, if Raoul Pal wants Bitcoin to go to 300,000, we need to solve all these problems. We cannot just ignore them and think they're going to solve themselves. So DeFi experimenting is excellent, but DeFi not trying to avoid all the rules is not a good thing.
Yeah, and we've seen in the last several months some notable examples of regulators reaching out to people who were not following those rules, who were not compliant, especially those who were offshore.
Exactly, and those were the exchanges that were, again, the BitMEX. I think you're talking about BitMEX. They were a perfect example of an exchange that was the tail wagging the dog, because they were the ones moving the prices the most during volatility. And this is exactly what the regulators are afraid of, right? Somebody who has his own reasons why they want the price to go up or go down, and they exaggerate the movement because they have a prop desk right inside the organization that makes sure that the penny always lands on heads, right? So and this is exactly what people are worried about, and we don't want that, right? We want a mass adoption, both from the retail side, the institutional side, the corporate side. And we're just seeing the sprouts of that. But to get it, to get people to commit, we as an industry need to pass through due diligence and through compliance. And the problem is that when these big institutions try to get through the compliance part, they can't, right? And what we do, we lose hundreds of billions of dollars that would have already joined crypto. I mentioned VoIP before, and how in the first few years we got 500 million users because it was so easy to sell VoIP. Anyone you walked to, you said, how much you paying with AT&T to call your parents in England or in Israel? And they said $3 a minute. I said, how about 20 cents a minute? And you had 100% conversion, right? Here, the trust level is dramatically higher. People take much longer to be convinced to give you their dollars. And then you have all these issues that everybody thinks that crypto is used only for nefarious reasons. So the bar is much higher. The adoption is much lower. We're still at that 50 or 60 million user base, and we need to be at 500, right? So great, we got PayPal and we got Cash App, and Celsius partnered with Line, which is 680 million users worldwide, right? So we have these amazing companies offering this beautiful service, but we haven't finished the foundation, and we're already building the third floor, and we're all excited that we're going to have a balcony. You know how that ends.
Yes, we do. To shift gears back onto the tech side, because there were a couple of questions that I wanted to ask you. You guys went with an ERC20 token. Why was that? What were the advantages that you saw?
Look, there are 150 different blockchains already. I thought the last thing that the world needed is another Mashinsky blockchain. So, and our power as a community is by pulling things together, not by spreading them even further out. So we took a bet on Ethereum. It was a very young protocol in 2016 when we looked at it, and in 2017 when we actually deployed the stuff. And I'm very happy that we selected Ethereum. Obviously, that was the right choice. And not running our own blockchain was also a very important step. And it really made it very easy for us. I mean, we support, I think, 15 different blockchains today. So we run our own nodes on Bitcoin and on Ethereum and on Litecoin and so on. So we are definitely a participant. Our job is not to choose winners and losers. It's not like we're cheering for Ethereum and we want Cardano to die, or we don't like some other protocol that is competing with Ethereum. The community has to decide who are the winners or the losers. But for us to run our operations, we wanted a blockchain that already had enough adoption, that the risks were out of the kind of like is it going to get hacked? Is it going to scale? And so on. So I think we made the right choice, and the community voted with their wallets. I mean, again, over 3 billion in AUM, which is shocking. I mean, it's amazing. 6 months ago, we announced we had just over 1 billion, right? So, I mean, it's just phenomenal growth. And it all has to do with it's not that we are so good. Again, people are dying for yield. And they're dying for yield because the Fed and the banks are basically guaranteeing that for the next 10 or 20 years, you're not going to earn anything on your money. If you have bonds, or if you're putting your money in CDs, or if you're putting it anywhere else. So that is why you're going to have mass adoption in crypto, right? It's not because of PayPal. It's because of the Fed and because of the banks. So they are your biggest, basically catalysts for mass adoption.
Yeah, one of the cool things about your website is that you're very transparent about a lot of the statistics. I saw over $8.2 billion in loans processed to date, and 250,000 wallets active right now on the token. I'm curious how you think about your growth, who your future clients are going to be, and what you are projecting in terms of your strategy to get out there.
Yeah, so our goal is to, again, always act in the best interest of our customers, of our depositors. Again, I'm the largest depositor, so it's easy for me to act in my own best interest. But we also wanted to be inclusive and make sure that we bring the next 100 million people into crypto. And again, we're not trying to bring the not your keys, not your coin guys. They have their own solutions. They're comfortable doing their own farming. Great. Good job, guys. We're trying to bring the people who are not comfortable managing their keys, who are not comfortable with DeFi, who don't know if they need to buy a tractor when they need to do farming, right? So the point for us was that inclusion, look, crypto is only 15% women, right? So look at our management team, 50% women. Look at our company, 50% women, right? So you cannot do a revolution and exclude half of the population. So it goes down deep into what are the principles of the company? How are you going to bring the person that has only $100, right? And so, for example, our onboarding, we give you $20 if you deposit $200 or less, right? Or more, sorry. So we're trying to make the incentives work for the person who barely has a few $100s to their name. And they can benefit from compounding. They can benefit from the increase in the value of the asset, right? And they can really achieve financial independence, which most of them they don't see the light at the end of the tunnel. They don't participate in Tesla going up 4,000%, right? So how do you include those people back to be participants in the American dream, in financial independence, in being able to get your kids through college or reach retirement? These are the goals. For us, success is having as many of our users reach those goals. It's not about sell token is the best performing asset in crypto. It's about how many of our users participated in that appreciation. I can tell you that almost every one of our users has sell token. So they did participate in that appreciation. So that's how I measure success, right? Are the people on the bus with me benefiting just as much as I am, or am I that, typical Wall Street executive who gets to keep 90% of the value?
Right. And you actually post the top 200 hodlers list on your website. You're currently at the top 51,000 and change sell tokens valued, as you said, at over $106 million.
And 62 of those people are already millionaires. And I can tell you, because I know a lot of them, they were not millionaires when they joined Celsius. So even though our goal is not to mint millionaires, our goal is financial independence and financial retirement. These are people that write me every day and say, I now can get my kids through college. I now know how I'm going to finish the month. I paid all my high credit card debt, and I'm now saving for the future, right? So I think we're achieving many, many more goals than the banks who are supposed to do this for you are really delivering. And again, it's not that Celsius is so great. It's that the banks are so bad at what they're supposed to be doing for you.
So, Alex, if the goal is to re-engineer the American and global financial system, what does that trajectory look like going forward? How do you think about that over a 1, 3, 5, 10-year time horizon?
Yeah, look, it's a great question. I agree with all the commentary that you and your team are talking about every day, right? And I think you guys are doing an exceptional job educating the average Joe about the fact that this is not a normal recession. This is not a normal pandemic. This looks much more like 1932 than it looks like 2008. And I believe that the Fed printing more money in the last 10 years than it did since the dollar was created, right? More money was printed. Just this year, they printed 20% of all the dollars that ever existed. So that means that the inflation in dollar terms is 20%. Don't believe the CPI numbers, the Consumer Price Index. That means nothing, that your internet access went down. The question is, are the same dollars you're earning are worth more or less? And they are worth less. So I definitely agree with you guys that we're going to have very high inflation. I agree with you guys that there's going to be a debasement of the dollar. The problem is that because everybody's printing, all the other central banks are printing as well, we don't feel anything. It's like it doesn't get hotter in the pot. Like the fire is on, but we still don't think that the temperature is rising.
So we don't see it in goods and services. We see it in asset prices.
Right. We see that huge inflation in asset prices because where did all that money show up? It showed up in the stock market. It showed up in banks lending people on margin because they're not willing to issue a loan for you to open a restaurant. But if you want to buy 3 Tesla stock shares with your 1 share that you own, of course, they'll do that in a minute. So the inflation in assets is the opposite of what the Fed should be doing, right? The Fed should be funding the average Joe to restart their business. They should be funding innovation into blockchain and artificial intelligence and machine learning. But the problem is what the Fed did, and everybody thinks they did a great job. Let me describe it in kind of like a visual terms. The Fed put this giant net under the US economy. And the problem is the net has giant holes in it. And through those holes, all the small businesses fell to the bottom. And all the big businesses got caught and got bailed out. You were a big bank, you got bailed out. You were Boeing, you got bailed out. You were an airline, sure. How much money do you need, right? So, but if you were a restaurant, if you were a pizza shop, or if you were a hotel, a small hotel, you got nothing basically. So my point is that the economy is going to have to go through a restart, and we are having the second COVID wave, and we are in a slow motion depression, right? It hasn't hit us yet. Why? Because the Fed sprayed $3 trillion. The Fed and the monetary system, basically the government, sprayed $3 trillion on everybody. And what did we get out of that? Nothing. We just deferred the crash, basically the depression that we're going to have to go through. And you guys describe it better than anybody else, telling people again and again and again that all this debt is going to have to be refinanced. And I'm predicting that in the next 5 to 10 years, the Fed is going to have to bail out all the financial banks. And they may have to do it with a digital currency where they give you a new dollar, a digital dollar, in exchange for the balance you had with JP Morgan or the balance you had with Citi. And you now have a direct relationship with God. You don't need a messenger in the middle, right? Because basically they're going to rebase or remonetize the system, which is what we did with the green buck. We did that once again. We eliminated all the debt and gave everybody a fresh new dollar. So now we're just going to give you a digital dollar. And Europe is going to have to do the same thing with all the European banks. And obviously Japan has already been doing that. Basically, they bought 80% of all the equities and all the debt that the country has. So it doesn't end well. And it definitely doesn't end well for you, the average Joe, because your retirement plan is worthless, your savings are worthless, all that stuff is really, that's why you have to be non-correlated asset. You have to be in gold, Bitcoin, and the higher your allocation there, the higher the chances you're going to get to the finish line.
Yeah. Well, you've just said what we've been saying on RealVision. We've reached a point where we've had the total overlap or integration of macro on the one hand and crypto on the other.
You guys should have 10 times as many subscribers. I mean, I agree with everything you guys are saying, and you have a great following. And I think the more we spread the word, the more we're going to help people basically control their own future, right? Control their own destiny. Because again, Bitcoin is not connected in any way to the Fed. It's not connected in any way to the dollar. And one Bitcoin is still one Bitcoin. It just now takes $18,000 to get one, where it used to take $100 just 10 years ago.
Alex, that's a perfect place to leave it. Thank you so much for joining us.
Thanks for having me, and keep doing what you're doing.
Hey there, since you got to the end, I'm guessing you liked the video. And that's probably because we don't just turn on a camera and film. We work really hard on getting the narrative flow just right. And that's why many finance companies are actually now hiring RealVision to make videos for them. One of our recent client videos just hit 100,000 organic views on YouTube, and there were no kittens in sight. So if you want to find out how RealVision can make a video for your company, just email us at customvideo@realvision.com.